Yes, after a long summer break, the Savings Tip Jar is finally back for 2023 to talk through the matters impacting your finances. And what a year it's set to be for Aussie finance. And of course, alongside me for another season of the podcast is Harrison Asprey. Welcome back, Haz.
Thanks, Dom. It's good to be here. We have a bit of a makeshift hosting room today, but never fear, our voices will be delivered to your speakers well and truly, and will be sounding good. As I've said earlier, summer is 2/3 over, but finance is just heating up in 2023. So hold your hats. I'm caffeinated with a 7-Eleven coffee due to the cost of living rises. So yeah, happy days. Let's go. Let's get into the first episode of 2023.
Well, those coffees, even they've been hit with inflation, right? Because it used to be famously a $1 coffee from 7-Eleven. Is it still $1?
No,
I think so.
100% inflation.
It's a $2 coffee
It's
now.
a $2 coffee.
Wow, that is a bit higher than the inflation rate, isn't
It's
it?
more than my paycheck increase, that's for sure. So, yeah, not good.
Tough times. Yeah, no, as I said, it's going to be probably a big year for Aussie finance. Obviously, we've got the RBA cash rate at I don't know, multi-decade highs. I can't remember the last time it was this high.
Yeah, 2012.
You've got, but that's coupled with much higher household debt than what we had back then.
Yeah.
You got, all those people who are still on those fixed rates. They're due to expire, a lot of them this year. We're hearing around 350 billion. That's going to be a pretty tough time. We've got, government budgets. We've got electricity price rises. There's no year in finance is ever really easy. But
no.
I think this year in particular it just stands out.
That's a lot of talking points, that's for sure.
Yeah, for sure. So
let's talk about them.
Let's get stuck into them with our savings news roundup. So item 1.
Yep, first cab off the rank. So this is being recorded hot off the press of the RBA movement for February. They don't meet in January, so this is the first cash rate hike in 2 months. Dr. Philip Lowe's finished his triangle sandwiches and he's delivered Australians a rate increase. So the rate increase was 25 basis points to 3.35%, I think, Dom, which is the highest, as I mentioned earlier, since I think June 2012. But a lot of factors were different back then. And I think I hear that savings account rates haven't really kept up with the rate of cash rate increases and home loan rate increases. No. So savings and savers are still getting shafted a little bit there. But Dom, there was a bit of talk that the RBA could pause, or they could even hike by 40 basis points, which would satisfy a lot of OCD nerds, with bringing the cash rate up to 3.5. Hey.
Yeah, 3.35 is still one of those kind of awkward numbers for a lot of people. Everyone just loves a solid, 25, 50, 75, 1.25. So some people are thinking they would eventually do the 40 or something to bring it to back to those sort of usual numbers. I don't think it's worth risking Australia's economy just over a bit of OCD.
Yeah, I don't think Phil Lowe's really worried about that.
Interest rates numbers. So, if they decide it has to be 3.68.3, then so be it. That's what the number crunchers and the economists reckon. We've got to set aside any of those kind of irrational feelings of it's not a 0.5 or a 0.25 or so
and have the volume knob on level 19, which would drive me insane.
So definitely hot off the press. We've just updated our websites with all that information and quickly jumped down here into this little room to record this podcast. But everyone was expecting this, right? 25?
Yeah, pretty much. There was a few sort of outliers. I think there was one piece of commentary that said the RBA should be abandoned and there should be public outcry and things like that. There's always a few kooks that have a contrary opinion, but 25 seems like the status quo these days. And it's in large part because of a certain few economic factors, Dom.
Oh, yeah. Well, inflation obviously is the big one. So the RBA is really trying to bring that inflation number down. It's inflation, what did we hit? About 7.8% in the December quarter.
Yeah.
I think on the same day we had the contentious monthly inflation figure coming out. It's a new index that ABS is bringing out. And that actually suggested that annual rate of inflation is about 8.4%, which is, just not looking too good. And you don't want to they keep hearing about the cat out of the bag. When the inflation cat's out of the bag, it's very hard to put back in the bag. And we're seeing around the world some promising signs of inflation coming back down. But in Australia, as yet, not quite. We are still spending quite heavily, and that inflation figure is running pretty rampant. So the RBA, they've got to work out, okay, obviously it's a big hit to the economy, putting up interest rates, hurts a lot of businesses and households with big mortgage debts, but perhaps that hit is not as bad as the hit that inflation is causing if it's allowed to persist.
Yeah, for sure. A bit of short-term pain for hopefully long-term gain. Maybe this might be the inflation or the cash rate hikes we had to have, to paraphrase Paul Keating. But look, the 7.8 figure is kind of, it's a little bit funny because you'll ask punters on the street, how much things have increased, and they'll say 20, 30, 40, 50%, but that's a weighted figure with a basket of goods, including technology, and they have random things in there like the cost of a hard drive and the cost of RAM and things like that, which are still pretty cheap. But as I was saying earlier, my 7-Eleven coffee has gone up by 100%. So yeah, the sort of street talk is saying a little bit different, and hopefully in the next sort of 6 months to a year that the RBA will have done its job. But one factor I always find interesting, and that I've been sort of talking about for a while, is HEX debt. So HEX debt, so like uni debt, is one of those few ones that just pause there. And then it's one of the few debts that is indexed to inflation. So with other debts, the principal remains the same. Whereas it's set to be a whopper. So every year, the government indexes the uni debt to the March quarter inflation rate. And if you think inflation's already 7.8%, it's probably going to be higher over the next 3 months. So a lot of sort of uni students and people with a HEX debt are going to be wondering if they should pay it off or just cop the inflation figure.
Yeah, I dare say, there'll be some people who their HEX debt will be going up by more than that they've managed to pay down over the year. Say your debt is $20,000 and it's set to go up by 7.8%. I think that's well over $1,000 being added to that. So yeah, probably nearly 2,000. So yeah, pretty tough times for some people, but HEX debt's one of those things that some people just don't, it's not really like a debt that you need to pay down as soon as possible.
Yeah, no one's coming to break your knees.
In these kind of abnormal circumstances where inflation's kicking in really high and it's growing it really quickly, yeah, it's kind of strange. You might actually be thinking, maybe I should pay this off before it gets hit with the 7.8%.
Yeah, exactly.
Yeah, we'll see how that all plays out. But you've got some news on lending indicators, Harrison.
Yeah, so speaking of debt, we'll talk about some home loan debt right here. So ABS figures, and this all plays into the RBA cash rate that we mentioned earlier. So new loans written in December were down a further 4.3% to a touch over 23 billion. Refinancing, however, which means switching your mortgage within the same lender or changing to a new lender to hopefully get a better deal, is still at all-time highs. So for owner-occupiers alone, that figure was elevated at $13 billion. And I found this interesting, Dom, too, because the people who are still borrowing, who can still afford to borrow, whose borrowing power hasn't been hit yet, they're still borrowing at elevated amounts. So the average home loan size in December was actually up $2,000 to $604,000. So that just goes to show that, the people who can will.
Yeah, well, that's interesting because, they're saying that property prices are falling at some of the fastest rates in history. So why would borrowing be up? Because
maybe their deposits are bigger. You never know.
Yeah. No, that's interesting. So, yeah, it's no surprise really that lending is going down a bit though. In sort of in total, with interest rates being much higher, people can't afford to borrow as much. Maybe they want to hold off on buying in this environment as well, where it's you're seeing all the scary headlines. And maybe you don't want to buy into a falling market if property is supposed to be falling so much. So, yeah, we're seeing that in the figures. in that sense, these rate hikes are doing their job. They're slowing down lending, trying to cool down the economy. We saw in those retail spending figures for December, shocked quite a lot of people with how much it dropped for that month. But people factoring in that, working in the fact that this whole Black Friday thing is quite a new phenomenon, and a lot more people are doing their spending in November instead of December. So that's impacting things a little bit, and the ABS, which is supposed to adjust for those sort of things in their seasonal factors, seasonally adjusted figures.
Yeah, but maybe they didn't yet. It is interesting too that the quarterly figure was down 0.2%, so that would account for November as well. So maybe Black Friday wasn't as strong as we first thought, even though all the data immediately after that pointed to a huge rise on Black Friday. So maybe people are starting to feel it, and the way they first feel it usually is not being able to spend as much as they can at eating out and buying footwear and clothes and things like that, and big TVs.
Yeah, and the RBA is kind of hoping that spending drops really quickly, because then it's a sign they're doing the job, and inflation should cool, really. But I mean, as we've seen, it's so much of our inflation is imported around the world.
Ukraine.
Yeah, Ukraine, and the stuff in China as well, like shortages of products, just less outputs. But I think they're finding that supply is starting to catch up to start to meet demand, and that should hopefully cool down. So there are hopes that inflation has peaked, that we won't see it go any higher than 7.8%. The RBA had expected it to be 8% by the end of 2022, and it was just under their projections.
Well,
so there you go. Hopefully it's on its way down soon. Any other news?
Yeah, Dom, speaking of some lending sort of news, I believe you have some news for us.
Oh, yes.
About a lender.
Yeah,
Fintech lender.
I don't know if we've mentioned them before on the podcast, but it is quite a sort of a popular sort of challenger lender for home loans, Nano. But Nano is Nano more. It's they've been acquired by AMP Bank, so they've basically bought their home loan book, which last time we read, it was around the $550 million mark. I think in this environment, rising interest rates, a lot of these sort of non-bank lenders that can't take deposits are struggling to find funding for their loans, because they sort of have to tap into these, I won't go in detail to it, but securitization markets, global markets, getting funding, people investing in bonds and the like. They're finding it harder and harder to get that type of funding, and thereby they can't really write any new loans. So we had seen that Nano had actually suspended taking new applications for home loans back in October, I think it was. And it was a shame, because a lot of people were really liking their application process with Nano. I think they boasted a 10-minute mortgage. You could start your application and be fully approved pretty much within 10 minutes. Really cool tech, but now we've seen that tech was kind of, I don't know if it was acquired, but they announced there was a partnership with AMP where they were going to share this tech with them. So I guess, maybe the writing was on the wall that AMP was actually was acquiring that to buy out their mortgage book in the end. So I don't know if that's the first and last one we'll see over the next few months of these little non-bank lenders having their home loans switched across. It might be a bit annoying if you're a Nano home loans customer, and you went with Nano for a particular reason, and now you find you're an AMP customer, and perhaps you don't really have to do too much initially. I think they said in the email they're going to guide you through it all. You kind of don't have to do anything. We'll switch it all across for you. But maybe you think AMP doesn't quite align with your values or whatnot. I don't know. So who knows? There's other popular non-bank lenders out there, such as Athena. They're very, very popular. Probably got much more than 550 million loans under management.
I would dare say so. Yeah.
It would be a bit of a shock, but it's not beyond the realm of possibility for some of these non-bank lenders.
It's kind of funny, Dom, because I've heard sort of mixed reports around just how big their loan book was, and I'm sure I could reach out to them and ask, hey, how big was your loan book? That might not be public knowledge anymore. But our fellow journalist Jacob and I attended a sort of lender summary from Nano in about mid 2022, and they said they mentioned that they had $550 million in home loans under management. But then I was reading some other figure that they had about 400 million. So maybe they've had a huge discharge, because I remember talking to the CEO, and he said, that their focus was never on the lowest, sharpest of the sharp rates. They were more focused on their 10-minute mortgage, which we saw in real time. You could upload all your documents, and then it could run through the algorithm and the AI and whatnot, and you could be approved for a home loan in under 10 minutes. So they were never really about the sharpest rates, although they still did have sharp rates. But yeah, they were more focused on really fast home loan approval times, which maybe wasn't really enough for them.
Maybe.
Yeah, and to be a non-bank in this time where you can't take in customer deposits is it can be quite tough, especially for these new players such as Nano and to a lesser extent Athena, which I know had a few hurdles in the back half of 2022. So yeah, time will tell if 2023 is the year that fintech lenders sort of go away a little bit, and more money is piled into the big banks such as AMP, Westpac, CommBank, whatnot.
Yeah, it's not even just in the home loan lending space though that we've seen these kind of non-bank kind of fintech disruptors. So disruptive. Then sort of getting snapped up. They sort of launch with big promises to take on the big four, and we're going to do things differently, and it's the same with the banks as well, like neobanks. Remember all those neobanks that popped up?
Oh yeah.
And then kind of ended up just launching to take on the big four, and then quietly sort of selling themselves off to the big four. I mean, we saw that with 86-400.
Yeah.
They then got acquired by UBank, which is
part
of NAB.
They got acquired by NAB, who owns UBank.
Yes. For
about $200 million. So the CEO there pocketed a few $100 bills there.
Yeah.
And then they got absorbed into UBank, and Zinja just flat out just collapsed pretty much. I still have one of their debit cards, which is a very attractive hot pink card. It still sits in my wallet. So.
And then even in the the buy now pay later space, we've just seen OpenPay is no longer. So yeah, it is a bit of a shame, to sort of see these kind of new and exciting new challenger brands popping up, and then now finding it quite tough in this environment. But I suppose that's business.
That's capitalism, baby.
All right, now it's time for Good Deal Hunting, inspired by the film Good Will Hunting. How do you like them apples, Harrison?
I like them a lot. To borrow a line from Dumb and Dumber. So let's talk about some good deals. So what caught my eye this week was the new Qantas Money home loan. So the airline, fronted by Alan Joyce, actually has a whole finance department. So you probably come to know them to offer credit cards and travel insurance and related products and things like that. But they now offer a home loan, and the rates might shock you. So the rate is currently, although it's probably going to go up now with the RBA movement, it's currently 4.69 for owner-occupiers paying principal and interest, and the comparison rate there is 4.73, so that's pretty close, which sort of indicates that fees are quite low. And for investors, it's 5.02% for the advertised rate and 5.08% for the comparison rate. So again, a pretty smooth margin there. And the kicker is you need to sign up to the Qantas Frequent Flyer program, Dom, which you may already be part of. And the kicker here is you get 100,000 Qantas points when your home loan settles with Qantas Money. And then you get 100,000 Qantas points every year thereafter for up to 30 years. So, in 2053, you could be accruing your 3 million or 30 million points or whatever it is, and you may finally get to be able to afford a business class flight to Dubbo. So it's also interesting too that the home loan is actually provided or underwritten by Bendigo and Adelaide Bank, so one of Australia's largest banks, and they also underwrite I believe TikTok and Upbank, Dom, which I believe you have some experience in the former.
Yes, TikTok I've had some dealings with, my own sort of personal finance life, but I won't go into too much detail there, but that's it's a pretty tempting offer, absolutely. The interest rate is good, but those 100,000 Qantas points. One of our previous guests on, I think on the last episode, the end of last year,
episode,
Daniel Skiberis from Point Hacks. He actually has a way of valuing these points. He values one Qantas point at 1.8 cents. So 100,000 Qantas points is worth $1,800 essentially. So if you're getting 100,000 on the sign up and then 100,000 Velocity points every other year, that's a lot of sort of flight points. Honestly, I don't think you'd ever have to pay for your flights. Unless you're flying quite a bit. But if you got basically $1,800 worth of flights every year, it's a really good value and it's very tempting.
Yeah.
I was just kind of trying to see what's the catch here, but the interest rate's good. I believe you can add an offset account for maybe an extra fee.
Yeah.
It's all sounding pretty good, to be fair. I mean, who knows? I mean, with 100,000 Qantas points for every year, maybe they can pull that at any time.
Well, yeah.
After like 2 years, they're like, okay, sorry, we're not giving that out anymore.
And then does inflation hit Qantas points the same way? They business class flights to San Francisco suddenly cost 50 million points in like 3 years' time. Like you just never know how they truly value those points.
Well, the value of those points depends really on how you're using them. Like I think I've heard that if you're using those points for just in like the little gift store that they have where you can buy like a kettle or a pillow or something with it, you're actually getting really bad value for your points. Like the value of those points is like, 0.5 cents. So that's not an actual number, but I think that's what Daniel has done in the past. And the best bang for your points is using them on like business and first class flights.
Yeah, that's what he said, right? Not bother with economy, to just save them up for a business class flight. Yeah.
So that would obviously use up a lot of points very quickly. But I think that sort of worked out the best value for your points. But definitely a very interesting offer from Qantas there.
And before we sort of change into your good deal, Dom, let's talk about my good deal a little bit more. So that's available on up to 5 investment properties too.
Oh,
so
really?
If you have a home loan portfolio, you can get 100,000 points per year for each property.
Really?
So if you are lucky enough to have a lot of home loan investments, you can also rack up a lot of points and travel and not spend any time in Australia.
Insane. Yeah, Qantas has definitely landed with a bang in the home loan market space, but it doesn't sound too good. You don't want your Qantas plane landing with a bang too often.
You can watch air crash investigations in your Qantas Money home loan home. Yeah. Anyway.
For my good deal hunting this week, I was just thinking, obviously, on the back of another RBA rate hike, a lot of borrowers, particularly those that borrowed to the hilt when interest rates were at record lows and property prices were at record highs. Some of those like young first-time buyers just absolutely borrowed through the nose to get one of these really expensive houses. They might be really seriously struggling with these. We've had 9 rate hikes in a row, and the first few were basically double rate hikes. They were 50. So if you're in pretty dire straits, you might actually even be looking for an interest-only home loan, like switching your home loan from principal and interest to interest only, because that would pretty drastically lower your repayments. It's not to be taken lightly, obviously, because when you're on an interest-only arrangement, you're not paying down the debt for that time. You're just paying interest, and over the life of the whole loan, you will end up paying more in interest because you've got several years of just paying interest with no debt reduction. But I thought I'd have a look around to see. Are there any sort of good rates or semi-decent rates available in the interest-only home loan market? And I did find one that did stand out to me that looked pretty competitive. Even as a principal and interest loan, its interest rates would look pretty good. But this is an interest-only rate. It's from IMB Bank, so one of those customer-owned banks, I think. Are they
based in the
Hunter Valley? Yep. They're offering 5.04%. This is correct at the time of writing. This is actually before the latest rate hike. So this will probably go up by 25 basis points. But yeah, 5.04%, and that's a 4.93% comparison rate. So it's actually a bit lower than the advertised rate. I think because they give you maybe a loyalty discount after a year or so.
Makes sense.
So yeah, that just shows you can get a pretty decent rate on an interest-only home loan, and you can go interest-only for up to 5 years. So say you're in a pretty tight spot at the moment, and you're really struggling with these repayments with interest rates being as high as they are now, but maybe you expect interest rates might come down a bit. Maybe you think you're going to get a few good pay rises over the next few years, and then maybe after 2, 3, 4, even 5 years time, you might find yourself in a much more comfortable position to start paying down that debt, and you can switch back to principal and interest. So yeah, just keep that in mind. Often some lenders as well will just restrict the ability to go interest only to only the first 10 years into a home loan term.
That's still a good amount.
If you're up to your 15th year into your 30-year home loan, you probably won't have that option available to you. But say you're one of those recent borrowers that's just taken out a 30-year home loan, maybe you're 1 or 2 years into it, going interest only might be an option available to you. But keep in mind as well, a lot of lenders are a lot stricter with their lending at the moment, and they might look at your position and see you as quite a risky borrower.
You might need a bigger deposit to
you might not have much equity. The value in your home might have dropped, and might have boosted your LVR to be over 80%. So
not good.
excuse me. Just keep that in mind too. So yeah, that's my good deal hunting, interest only.
I'll probably just make a quick comment on that too. So that IMB loan was for owner occupiers, but you don't necessarily need to be struggling, I guess, to kind of maybe take out an interest only home loan or to take advantage of one, because investors too, they can. There's a lot of tax deductions you can make, and home loan interest is a deductible thing that you can make as a property investor. So realistically, you can reduce your home loan repayments to virtually nothing. This isn't financial advice. I'm just saying this is an avenue for property investors. Is they can reduce their home loan repayment to virtually nothing, and then have an interest only period of 3, 5, even 10 years, and then hopefully if they sort of bought at the right time, they could sell that property and then make their money back, get profit, and then just pay off the home loan in its entirety without having really paid anything. So that could be suitable for people who don't really have the cash flow to be paying their principal repayments. That's an avenue there for property investors. But yeah, you really got to tread lightly there and speak to an accountant if that's what you're thinking of doing.
Yeah, it is a tricky spot. But I have heard that property investors do quite like the interest-only option. It is a much more popular, is more prevalent among investors than it is owner-occupied borrowers. So, yeah, don't forget about that option there, interest-only home loans. And you know what? With all this talk about the fixed-rate mortgage cliff that's happening, I remember about 4 years ago or so, all the talk was about the looming expiry of interest-only home loan periods, and everyone's saying, "Oh, there's
the next thing, isn't
X billion worth of interest-only home loans expiring, and those are going to switch to principal and interest, which means repayments are going to go up 30%. How are they going to handle this?"
Oh man!
And you know what? I really didn't hear too much about it.
Yeah, what happened to
Everyone's always expecting this big cloud on the horizon.
Chicken Little.
To happen. Yeah, a bit of that. But I mean, but that's no denying that this fixed rate mortgage cliff is obviously quite a big deal, and worth seeing how it all plays out. But a lot of economists are coming out there saying, look, we're actually finding that a lot of households are in a good place to actually be able to handle these. So, yeah, but as a friend of ours always says, TWT.
TWT.
So, yeah. How about some fun facts?
Yeah, let's talk about some fun facts to change tack a little bit here. So, Harry O'Sullivan, one of our journalists, actually wrote a story about the cost of unused subscriptions. So maybe you've got a Netflix account you haven't used in 3 months, maybe you've got an Adobe product you've long since forgotten about, you've let your Instagram go to rot so you're not using it. But a survey from ING, so they're the ING bank there, indicates that Aussies are wasting up to $105 a month or $1,261 a year on unused subscriptions. Now, I think they included things like tolls and like road tolls and other things in that figure, which is kind of a bit ambiguous, but still a pretty startling figure. And the average Aussie spent $48 extra per month on online subscriptions in 2022 than they did the year prior. So I thought that was pretty interesting. So there's a lot of money there that you could be cutting out, and you've sort of got to review your bank statement to make sure there's not money coming out of from Disney Plus or Netflix or whatever, to make sure you're not just gurgling money down the drain essentially.
Yeah, I was thinking about this the other day because we sort of couldn't find any shows we wanted to watch on Netflix or Stan, so there was a couple of shows on Apple TV that we had our eye on that we'd heard good things about, and we just bit the bullet and took out an Apple TV subscription. And then like the next day I went to go onto Disney just to watch some silly show or whatever, just to sort of take my mind off things before I go to bed. And I saw that my fiance's sister's account that we were borrowing was no longer working active, so I think she cancelled it. So I then took out my own Disney Plus, and then I just thought, what, I think that officially means we have every single streaming stuff, bar Amazon Prime, but we've been on and off that over the years. And I'm just thinking, man, am I blowing way too much money on this kind of home entertainment stuff?
Yeah, back to the old days of, like 10 years ago when you'd think you were paying lots for Foxtel at, $50 a month. Now it's just come full circle.
Yeah.
But there is some, good shows out there, not advocating, wasting money, but the one with Jason Sudeikis, where he becomes a soccer coach in the UK.
Ted Lasso.
Yeah, Ted Lasso.
Yeah,
that could be worth it too. Yeah, look, just make sure to review your statements and make sure there's no subscriptions or you're paying for someone else's leeching of your streaming service, like Dom was. But anyway, unused subscriptions cost a lot of money, and it might not be too good for those on a minimum wage, Dom.
No. So minimum wage, good little segue there. I was just, looking at the OECD, and sometimes just like to see how Australia stacks up in the world as a country, and I was curious about minimum wage and how Australia is going there. Australia actually has the third highest minimum wage in the OECD.
Wow.
That's after Luxembourg and the Netherlands. So that's pretty impressive, I think, for the land down under. This is according to 2021 OECD data, by the way. And basically it said Australia's minimum wage, annual minimum wage is $25,258 US dollars per year when adjusted for inflation, and a little thing called PPP, which stands for Purchasing Power Parity, Mr. Maturity. And that purchasing power parity accounts for differing levels in the cost of living. Because you might say, the cost of stuff in Australia is so much higher than it is in, say, the US. So, that's why minimum wage is high. But no, this is adjusted for that. And even after taking that into account, we're still the third highest. So, yeah, that's pretty good for Australia. Just to put that into context, compared to some other English-speaking countries, our friends in New Zealand, just behind us in 4th position.
Good on them.
The UK down in 7th, and the US was down in 16th. And that's out of 38 countries. So the OECD is only made up of 38 countries. That's out of the 195 or so countries in the whole world. But that 38 represents about 80% of world trade. So it is counting for the big players in the world. The bottom 3 in that list were Russia, Brazil, and Little Mexico down the bottom.
Little Mexico.
So, yeah, that's my fun fact.
That is a fun fact. The little Aussie battler's doing well, and since 2021, I think last year we had a pretty sizable increase in the minimum wage, so I think it's crept over $20 an hour now.
I wouldn't be surprised if we saw us, pushing second or even first position.
Yeah,
now,
probably.
We are, Aussies are known for their holding egalitarian values close to their hearts. It's all about equal opportunity. Everyone gets a fair go.
Yep. Please explain. And just as an aside, Dom, do you know what the OECD stands for?
The Organisation of Economic Cooperation and
that sounds good to me. Something like that, development.
Something like that. Yeah, I probably learnt it in high school economics. don't we have? Isn't there a former Aussie politician that's heads it up now? He heads up one. I think it's
Not Alexander Downer.
No, he was an Aussie politician, but he was like Belgian, like he had an accent.
Oh, Matthias Cormann.
Yeah. Pretty sure he's head of the OECD now.
Good on him.
So maybe he's fudging the numbers a little bit to make Australia look good.
Terminator accent.
Who knows? Okay, time to get your submarine out because it's time for Savings Sonar.
Cool. Yeah, let's talk about what's on the horizon. So I think I'll just go first. Let's talk about wages growth data. Everyone wants to see their wages going up, and this will be a big tell for what the RBA sort of looks at to do next. The latest wages growth data for the December quarter is out on the 22nd of Feb. So that'll be pretty telling, and I always find it interesting, to me anyway, it's the most interesting sort of big economic piece of data that comes out because it always comes out a bit later than inflation. And you know, like whenever it comes out, there's always been like 3 interest rate hikes and things like that. So hopefully, I think the last result was around 3.5% or something like that. Hopefully we'll see that push higher still because there's all this talk about the Great Resignation, but then at the same time, there's all these like lenders sort of going bust, and there's all these crypto platforms sacking a bunch of workers and things like that. So who knows? It's a real mixed bag here.
Yeah, it's one of those. I think wages growth is one of those kind of weird things that, like, obviously we want to see it going up and trying to catch up to inflation a little bit, but I think people like the RBA would actually like to see wages growth not pick up too much because they know that inflation and wages are very closely intertwined. Because the cost of labour impacts the cost of goods, right? Because the labour made that good or provided that good as a service, so it impacts the cost of the goods. So I think they're worried that if wages growth it gets entrenched and everyone's expecting 4, 5, 6% wage increases, then that will sort of bake in inflation at those levels. So that's where we're starting to hear little conflicts between say like union groups and like having to go at the RBA for expressing these views that concerns about wage growth going too high. So if wages growth is shown to have picked up quite a bit, that's probably means the RBA is more inclined to raise rates again.
Yeah.
So that's it's definitely an interesting blip on the sonar there. To keep an eye out for what happens with wages growth. For my savings sonar, pretty simple one. Obviously, we've just had a rate hike, so for all savers out there, they'll be wanting to see what happens to their bank account, savings account interest rates. Home loan interest rates aren't too interesting when there's rate hikes because it's almost pretty much guaranteed that each lender will hike by at least 25. I don't think I've seen anyone yet not pass on a rate hike.
I think there were a couple early on, and they made a big song and dance about
Well, maybe they didn't pass it on in full.
Yeah, we didn't raise the cash rate. We didn't raise our mortgage rates by 50 basis points, but we raised it by 47. So come to us.
Yeah.
But savers, it's good news for savers.
Yeah. But for the savings accounts, we're not seeing them, being guaranteed to be passed on the rate hikes. I think we talked about it slightly earlier in the podcast. If you look at the last time the cash rate was as high as it is now, the average savings account rate was much higher than it is right now.
Damn.
So that just shows that a lot of these, particularly the bigger banks, they're not really passing on the rate hikes.
No.
Well, it's particularly to those kind of just the basic sort of savings account that you don't have to do anything. You just deposit your money, you earn your interest. Whereas on the other hand, we're seeing those kind of conditional bonus savings account interest rates. They actually are going up quite a bit.
Yeah.
But there's all these hoops to jump through. You gotta make sure you grow the balance. Sometimes you gotta make 5 transactions. They used to be all about encouraging people to save.
Yeah.
So meanwhile, they're sort of saying, no, we want you spending as well. If you spend with the card, we'll give you your bonus interest. Which used to be, you'll get your interest if you don't touch your account at all. But no, they expect you to spend. So I don't know. I think consumers and savers can maybe well within their rights feel a little bit ripped off by what's going on at the moment.
100%, yeah. And I think it is interesting too with all those bonus conditions. Like I think they're trying to maybe foster a bit of customer loyalty. You know, it's too hard to unwind from this bank and change to a bank because, you know, I won't get my interest this month and I got to like make my transactions, you know, because if you have conditions such as deposit at least $1,000, sometimes it's even $2,000 a month to get the rate, make 5 transactions, that essentially means you need to put your pay in there and you need to transact and buy the groceries and things like that. So if you're running a family, you might not have the time to really think about how you're going to unwind from that product. And that was what the Royal Commission in the finance sector was a few years ago, right? Was all these sticky products around home loans, you know, the package rates. It's really, really hard to unwind from these products. But look, on a lighter note, if you make those bonus conditions, you can get a good rate. I think, you know, at the time of recording this, you know, we could get back to our desks and everything's changed. But BOQ currently has the highest savings account rate at 4.75. And could we see savings rates jump up to 5%, which we wouldn't have seen in ages?
Yeah, I mean, BOQ, if they hike that maximum rate to buy the full 25, that will take it to 5. But that rate is only available to those aged, 18 to 14 to 35 or
14
something.
14 to 35, I think,
and that rate is limited to just the first 50 grand you put in there. Anything above that won't earn that rate. So, you know, you get conditions like that, you know, it might look great, like a great rate on paper, but it's limited to this subset of people and only this bit of money, and you also have to, you know, deposit this, make this many transactions, and it's like, oh, come on, give me back to the days when it's just a basic savings account. Maybe you could access it online. And that was it. You'd earn your 3 or 4% and go home. To be fair, there are, you know, some banks who are offering those sort of set and forget
unconditionals. I wonder if we'll see the first special savings rate for people over 6 foot tall or under 100 kilos or something like that. You know?
No.
Maybe.
Surely not. Because in this day and age, you definitely can't judge people on their physical characteristics.
Well, you can't judge them on their age either. But anyway.
So let's see how it all plays out. Hopefully, we start to see some better deals on offer to those hard-working savers out there. You know, Harrison, I think that wraps it up for the first podcast of the year. Yeah,
that's a great first episode in the bank, so to speak. Nice. Had a good time with you as always to chat about what's making our money move and things like that, and some money masticating. That's masticating, so chewing. I hope to see you again in the hot seat again in a couple of weeks' time, where we can chat about all the fallout from the RBA and who's moved rates and things like that. It's going to be a good episode, I think. Yeah,
absolutely. As I said, you know, it's going to be a very interesting year. Plenty to talk about in the realm of finance. So we'll continue to chew the fat over that, masticate, as Harrison said. Thanks to everyone, to those listening to another episode of the Savings Tip Jar. Really appreciate your support, and we always appreciate any thoughts or feedback you might have. So don't hesitate to get in touch via Savings Facebook, Twitter, Instagram, or shoot an email to inquiries@savings.com.au, or just turn up on Harrison's front doorstep. We'll happy to receive any feedback you might have.
Get off my lawn.
All right, that's enough. Thanks. Bye.